Hi. I'm here with Nick Nash, who, if you don't know him, is the group president of Garena. And we're going to talk a little bit about diversification. So moving into new markets can be a risky move for a company, but one that has managed it successfully is Garena. The company started out as a messaging app and has since grown into a platform with a social network, online payments, and P2P shopping worth roughly $4 billion-ish. So Nick, this diversification, has it been all plain sailing? Have you had any difficulties?
No, it's a great question, Alex. And before I jump into your question, first of all, thank you all for those that are in the audience. It's a great honor for us to be here, and I'm very, very humbled to be amongst all of you today. Frankly, we have 1,000 times more to learn from all of you in the audience and all the wonderful companies presenting than we have to share. But I'll try to be as candid as I can and as direct about the things that we've learned the hard way along the process. As Alex mentioned, we were founded in 2009 as a messaging platform and have systematically added countries and, on the other dimension, products onto that fundamental network effects centric platform. The first thing we added was professional for-profit paid content, which in Asia tends to be more game-oriented than, say, audio and video, as you'd see in the US or Europe. Then we added a payments platform to wrap around and have our users have more flexibility to pay. And then most recently, we did add an e-commerce platform called Shopee that's grown very quickly. I think there's two things that we've learned about how to expand into adjacencies. The first is the unbelievable importance of localization. And this sounds like it's motherhood and apple pie. Of course, you want to change the language of your product for a country, but that's what we would describe as low-resolution localization. It's the very superficial stuff. It's having the language right, the idiomatic expressions. It's perhaps having a local national as your country head in each market. The much deeper localization is almost down to the pixel level. It's down to the business model. It's down to the choice of business partners you use. And one of the examples we love to say is that low-resolution localization is knowing that Indonesia has 250 million people and 17,000 islands, and a little bit more factual data than that. High-resolution localization is knowing which professor at ITB, which is the best engineering school in all of Indonesia, has the best eye for spotting talent, and which people to hire from him or her. That's the difference that I'm talking about. So that's topic one. Topic two is, as you add into adjacent platforms and adjacent countries, can you find a coherent, logical thread that unites them? Or is this diversification for diversification's sake? And I think in our company, we are determined never to diversify simply to have more revenue or to have more products or to have jobs for people that have gotten bored or tired of what they were working on for the past 3 or 4 years. For us, the common thread is engaging the high ARPU internet user in Southeast Asia. And at a very practical level, that means owning the wallet. It means having a payment infrastructure that unites our content business and our e-commerce business in a single platform, which is sort of the equivalent of what might have happened in China 10 years ago if, in sort of a Gedanken experiment, Jack Ma and Pony Ma had dinner 10 years ago and said, you know what, you've got your content business, I've got my e-commerce business, let's unite the wallets together. And that common thread provides, I think, a degree of strategic coherence to what we're trying to build in our business.
Great. And I mean, is diversification for everyone? What's your sort of advice for startups?
Well, it's interesting, actually. So I think you can sort of call it two different kinds of diversification, and one may be a very bad idea for startups. The logical kind of diversification is there something else that we can do as a company that utilizes the resources we have? I mean, the classic example is if you're H&R Block and you're doing tax prep every April 15th, perhaps you ought to be doing something else that's tax-related in the other 11 months of the year, because you've got the capability and you ought to do it. If you're in the sporting goods business, you really shouldn't just be selling surfboards in June. You might want to be selling skis in November and December. So that's a logical, authentic, coherent form of diversification. What makes no sense to me, and I think we're seeing a bit more of this, particularly here in China and particularly in India over the last 3 or 4 years, is diversification into completely orthogonal pools of consumer spending that, you know, you have to kind of struggle to get the IR guy not to chuckle when he's describing this to his investors. It's really a little random. That kind of diversification is foolish, I think, because it doesn't use resources efficiently. It actually distracts you from your core mission of running your business. And frankly, that's capital you ought to be giving back to your shareholders if you truly don't have a good use for it.
Great. You're kind of talking about the mass diversification of companies like H&A Group and Anbang, not to name names, but this kind of thing that's that's playing out at the moment in terms of China outbound acquisitions?
Yeah, I certainly wouldn't name specific names, but I think as a broader theme, it's worth going back to the history of how other economies with trade surpluses binged on foolish diversification. And I think it's no surprise that the US, after World War II, had a fantastic trade surplus, and through most of the 1960s and 70s, you witnessed the birth of enormous conglomerates like Paramount and ITT and Litton, and even GE sort of fell into this trap. And all of that ended very badly. In fact, it created an entire industry called leveraged buyouts simply to peel off the random bits of these companies and re-empower them as individual businesses. You saw it in Japan when their trade surplus was high in the 80s and 90s. You're seeing it happening in China right now. You don't need to be in every business. Your shareholders can make that decision for themselves.
Sure. And I mean, this kind of mass China outbound push into mass diversification into other areas, how do you think it will play out? Do you think we'll see a shakeout, and if so, when will that start to take effect?
Yeah, I think you're asking a bit of the wrong guy, Alex, and that I know less about China than I do about Southeast Asia. Yeah. But if history is any judge, I think you'll see a big wave of leverage buyouts in the 2020 to 2030 cycle, which will be unpeeling all of these onions that have been sort of stapled together and really giving people a degree of focus. At the end of the day, every business that does something, unless there's that coherence to diversification, it should have its own cap table. It should have its own option pool, it should have its own board of directors, its own HR department. Let people do what they're meant to do and consolidate inside your business as opposed to finding orthogonal opportunities for growth.
And going back to your company, where do you see Garena in the next 10 years? Will you diversify into other areas? Or?
Yeah. It's interesting, and it's funny, I love to use the example of families when you think about building your business. Nowadays, you don't find that many families with 4 children or more, because it's just too damn hard. It's challenging to have a lot of children and to give each of them your attention, your respect, your love, to have a harmonious environment. And likewise in our business, I think running 3 or 4 businesses is about the most that we can do. We have a fantastic content platform, we have a fantastic payments platform, we have a great e-commerce platform, we have a messaging platform. That's enough right now. And for me, actually, the strategic focus is deepening each of those businesses in a very compelling way. And I think that should be the focus. For example, in e-commerce, rough math, Southeast Asia's got about 670 million people. There's about 3 to 4 trillion of GDP. Let's just call it $1 trillion of discretionary consumer spending that could be called retail. Only about 2% of that's online. I shouldn't be hunting in other pools of spend while just 2% of my market is penetrated. I should be focusing on that and really building that out.
Sure. And if we could just talk a little bit about fundraising. So you guys just completed a round of fundraising in the private markets. How is the market for private fundraising for companies like yourself in Asia at the moment?
Yeah, it's a great question, and we're very proud about the quality of the shareholders that we've encountered over the years and that we've welcomed into our family. We're an unusual quote-unquote startup in that we have no venture capital in our company. We had some angel money from one of the most distinguished families in Asia. We then had strategic capital in our Series A, and then we jumped immediately to private equity in our Series B, and there was almost a 4-year gap between our Series A and our Series B because the business, fortunately, and I think helpfully, reached break even and was producing cash flow at a very early stage. So what I would say is the following. Number one, I think the sea change from 2014-15 to 2016 today, and you see this a little bit in the VIX, but I think you see it much more practically in the way investment committees are making decisions on funding private investments, is business model matters now. There was a moment in time when revenue growth, or not even revenue growth, GMV growth or GTV growth was the much more important metric. Right now, people are pretty focused on business model, and as we love to say within Garena, when you have a multi-sided platform, whether it's Airbnb or Uber or Shopee or what have you, it's not like the Olympics. There's no bronze medal if you're number 3. You kind of have to be number 1 and maybe number 2. And investors are asking themselves the question, are you, with a greater than 50% probability, going to be the gold or silver medalist in your respective category, in your respective country or region? And if you're not, then the fundraising environment, I think, is very challenging. If you are, then the fundraising environment is modestly more benign. But I think it would be an exaggeration to say that we're back to 2015 levels. The VIX is still a little nervous. And in general, I think that people are skeptical of technology right now in a healthy way, which I think will lead to better capital efficiency in this business.
Sure. And you're already a big enough company to go public, I think it's safe to say. But and there's been a lot of speculation as to if you will, and if so, when you will. But I mean, before you take that step, when do you think that might be, and what geography are you likely to pick?
So I can't, of course, pin down a specific time or a specific exchange, but I'll make a couple of broad statements that I think have a logical conclusion.
What I'm trying to say is there something to be said for, I don't know, you're a big enough company now, but is there the case that you need to be a certain size to be a successful public company?
Well, I think one of the great tragedies for everybody in this room, certainly ourselves included, is that you used to be able to go public at a $400 or $500 million valuation and have a good aftermarket. And it's a bit like marriage. The wedding itself is not a great predictor of the quality of your relationship in the succeeding 40 years. Likewise, whoever your underwriter is in the IPO, it gives you almost zero correlative benefit to the amount of great quality research coverage and liquidity you'll have afterwards. And there's a big problem in the market. You used to be able to go public at 400, 500 million. You'd have 3 or 4 great analysts that would show up every quarter, do the homework, and they'd write thoughtful research. It may not be positive, it may not be negative, but it was thoughtful. That business model has really changed. And I think today, to get good research coverage, to have good institutional trading, and most importantly, just to have mind share among thoughtful institutional investors that are going to be long only and long time in your stock, you kind of have to be 4 or 5 billion of market cap. It's just really challenging below that, and I think that's a great, great tragedy. And the second thing that's happened is, just as you find a network effect in terms of multi-sided platforms gaining real scale, Google in search, Microsoft in operating systems, Uber in ride sharing, and DDYD in China, the same business, I think there's a handful of exchanges that have built real IP in terms of the investors that congregated that watering hole around technology. So there are many stock exchanges in the world, but probably only 3 or 4 of them are credible places for high-quality technology companies to go public. And the tragedy is that in many of those situations, they tend to be very regional. So if you're a great Indonesian company, or if you're a great Indian company wanting to go public, you might not pick your home exchange, but you probably wouldn't pick Hong Kong either, because that tends to be very China-focused. You sort of will gravitate towards the NASDAQ, and as a logical sort of corollary to that, you kind of have to be of a minimum size to really get the attention you want.
Sure. And who do you guys regard as your competition, and how are you staying ahead of them?
Yeah, it is different in each of our 3 segments. In our game segment, I'm very pleased that we've been able to build a position of durability, of endurance. There used to be a number of other game companies in Southeast Asia, but none of them had a true platform orientation in a way that we've been able to learn from our elder brother, Tencent. And as a result, in every country, there are firms that we respect and admire, but they're all rather smaller. On the e-commerce side of our business, this is a really interesting question. It turns out that in the segment of e-commerce that we're in, there's nobody else trying to do this across all of Southeast Asia. But there are many segments of e-commerce, and I've mentioned this in the past, and I think this is a very important thing for us to talk about as an industry. Our taxonomy, our vocabulary for e-commerce has not caught up with the nature of the business. We are still talking about B2B, C2C, P2P, or B2B2C, and at the end of the day, those are just random concatenations of letters. What actually matters is which of the 4 fundamental business models are you in e-commerce, and that hinges on 2 very simple, practical, operational decisions. Are you going to be asset light or asset heavy? And are you going to be consumer electronics heavy, or fashion and apparel and everything else heavy? That's 4 places you can play. Our friends at Lazada have chosen to play in the consumer electronics heavy, asset heavy business model, which is akin to a JD or a Flipkart. We've chosen to play in a different segment, which is asset light and non-electronics heavy. Only about 10% of our 800 million of GMV is electronics. And that ends up with a different sort of margin and return profile, but it's also a very different segment demographically and in terms of use case. We're very fortunate. In the month of April, we found that we had, all of our unique buyers, each of them on average bought 4.2 times, meaning about once a week. And that's an incredibly interesting place to play, as opposed to sort of the more male consumer who will buy a handphone or a smartphone every 6 to 12 months. So in our particular segment, there isn't competition, but there are other great companies like Lazada and others that are playing in different parts of that 4 matrix. And then lastly, in payments, honestly, the biggest competition, Alex, is cash. the problem that needs to be solved in emerging Asia, i.e. India and Southeast Asia, is how does the consumer without a credit card, without a bank account, transact with the money that she or he have earned in their lives? There's an enormous amount of friction for cash to be digitized and then used electronically. And that friction is actually the biggest competitor. There are a couple of companies, country by country, trying to do similar things, but no one else, again, is trying to do this across the region, because it's hard. It takes a lot of work.
And going back to diversification, but geographically, have you had any kind of, have you learned any lessons or had any challenges in diversifying your kind of geography in terms of being active across Southeast Asia?
Yeah, I think there's the prosaic challenges which are solvable and just take effort. For example, Southeast Asia is not the EU. There's no Schengen agreement. There's no ownership liberalization across. I mean, it's light years away from the continental 50, of the US 50 states, where a Philadelphia-based business can easily own its subsidiary in Seattle, no matter that they're thousands of miles away. In Southeast Asia, there are prosaic constraints that are actually seriously limiting the potential of Southeast Asia. And, I was at a conference yesterday, and we talked a little bit about this very dynamic. It's impossible to own a controlling stake in your subsidiaries in many parts of Southeast Asia, so you have to find elegant and locally mandated approaches to doing that. That is a real challenge in building our business, and we've had to do a lot of work, and we probably end up spending more money on accountants and lawyers than we need to for a tech startup, because that's just what the market dictates. I think the more substantive and the more fun things to talk about are the HR challenges, country by country. Mm-hmm. I'll just give you an example, and this is such a tragedy of colonial past. When the Dutch, bless them or not bless them, when they left Indonesia, where they were ejected by the indigenous revolution after World War II, they left less than 10,000 college graduates in a nation of over 100 million people. That is a tragedy of just catastrophic proportions. That meant that the country had to climb a ladder of human capital development that was almost 1,000 years behind schedule. And it was done specifically because the playbook for Indonesia was basically the same playbook for running Dutch Guiana. They ran it as a giant photovoltaic plant. The sun shone and they grew vegetables. It was just awful. So we are living with the legacy, I think, of a quickly catching up, but still off a low base educational system in countries like that. And then I think the last element is, because we are fragmented in Southeast Asia, and this is a surmountable challenge, but it takes some effort, how do we find people that have cross-cultural empathy? Someone grows up in Singapore, there's two challenges they have. One is they may not be familiar with the cultures and languages in our wonderful polyglot region. But the second thing is, and I don't want to overstate the case, but it's a very important point, they have cultural, consumer, business, intimacy, and fluency with a market with $50,000 of GDP per capita. That's a very different environment than Cambodia, with $500 to $1,000 of GDP per capita. So balancing the educational and the intuition that background that people have in markets with vastly disparate cultures and living standards is something that needs to be trained, needs to be inculcated, needs to be emphasized.
That's great. Well, thank you very much. I think we're about out of time, but thank you for coming, and thank you very much, Nick.
Alex, what a pleasure.
Cheers.
See you soon.